Hello everyone, we're at SuperReturn Amsterdam 2015 and I'm here to ask Nick a few questions about emerging markets. So Nick, you mentioned today during your panel discussion that you still see a lot of proprietary deal flow. How has your sourcing evolved in financial services over the last few years and how do you get that proprietary deal flow?
Sure, so I would say three things. First of all, if you've done a series of investments in the first place, in those subsectors, you're generally an expert, you know what you're talking about, and so therefore your ability to success begets success, and therefore convert those opportunities into a proprietary conversation is pretty good. The second thing that's going on is that the entrepreneurs are demanding greater capabilities from their GPs. So your capabilities are being tested by those entrepreneurs. And so unless you have a dedicated sector proposition, generally you are just simple capital, and that is something that is probably 10 years ago. And then thirdly, the conversations that we're having with entrepreneurs are becoming very much more pan-regional or pan-continental. And therefore our ability to differentiate ourselves by having those capabilities versus others is there. So if you combined repeat experience, capabilities on the ground in a sector, and a pan-emerging market proposition, generally that has allowed us to convert a small number of opportunities into proprietary discussions. And
do you find that that's a self-fulfilling, a virtuous cycle, so to speak, where you're building capabilities in certain subsegments of financial services, and then that's the entrepreneurs and the management teams that resonate, that you continue to then work with?
So the key theme that we're really finding is there's plenty of, if you break financial services into two things, the provision of money and the transmission of money, there's plenty of capital that understands how to provide money businesses, be that banks, specialty finance companies, insurance.
So
a bank is a bank
there.
is a bank, yeah? But there are a large number of financial services infrastructure, payments, credit bureaus, database businesses, brokerage businesses, where specialist skills are required, and a lot of that infrastructure in emerging markets hasn't yet been built. So if you've got that insight and that capability, you're going to have a very different conversation with an entrepreneur. And to be frank, a lot of what we've ended up doing is actually identifying the opportunity and then going and finding the management team to execute against it rather than reacting to events.
So when you think about the thesis that you have today within various subsegments of financial services, what do you like? What regions, what types of subsegments of financial services?
So I like subsectors in financial services which are per transaction revenue models. I like the operational gearing that presents. So two major themes that I'm really following. Number one, distribution businesses. If I can reach in a branded way a consumer and then have repeat businesses on a per transaction basis, that's a really attractive place to be, and that's generally intermediating against banks and other balance sheet heavy institutions. The second theme that I like is payments. Yeah? So our ability, particularly in an emerging market world where mobile payments and other non-traditional forms of payments are becoming rapidly adopted, our ability to take that expertise and apply it into markets where consumer take-up can be quite rapid, that's very attractive to us also.
And when you look, Nick, at the technology underlying those opportunities, we've seen across the globe really an increase in valuations for those types of opportunities. Do you see the same in financial services, and can you tell us a bit about where valuations have headed?
So valuations have gone up. And they've gone up across all our markets, and so you have to be really clear about how you're going to add some value in the context of making less money from buying low, selling high. And that's true for whether it's financial services infrastructure or balance sheets. Now there are huge discrepancies or variations in valuations across regions. So Nigerian banks at sub-book value, despite generating returns on equity of 20%, very different to a return on equity of 20% in India at 3 times book value. Now I'm not saying that means India's bad, Nigeria is good. There are very different local contexts that you have to understand, but you start with that sort of geographic filter up front.
And when you think about underwriting, so you talk about different segments and different geographies, how do you underwrite those types of deals, and do you vary the return requirement that you have by by geography or by segment?
Yes, we do. So let's start with a macro context. So we will be pricing in different currency expectations. We will be pricing in different macro conditions into an investment opportunity. Personally, regulation is a binary risk. You're either prepared to accept the regulatory risk of a financial services business or you're not, and so therefore you can't really price it in, you have to accept it or not. And then at a business level, yes we are. So we will price for different US dollar returns depending on the scale of the investment and our perceived risk of what the growth or execution risks are. So generally we will find we will have lower return expectations in bank balance sheet investing versus, say, the payments or the data world, where we will often believe that the growth rates are higher, but the execution risk is there, and therefore we price accordingly. And then finally, from a fund context, we also try and price to what capital gain looks like. So it's all very well to think about capital deployment and the returns, but a small investment with a large return can be just as effective as a large investment with a lower return within the context of building a fund framework.
And when you look back, Nick, on your experience as an investor in Africa, what do you think is the execution risk or the risk that you've perhaps sometimes underestimated when there's a variance in terms of expected return versus reality?
So
do you have an example?
Yeah, absolutely. So always, emerging market investors always have examples of things that don't go quite according to plan. Look, we lived through two revolutions in Egypt and through a large bank there. Two things that we generally find that when we look back we didn't get quite right. Number one, depth of management team. So we often get very excited about backing an entrepreneur or an executive leading a team, but when you're taking a business from medium scale to large scale, it's really making sure that there's the depth of team and the culture that enables that to happen. And if I think about some of the situations where we've ended up not taking full advantage of the potential of the demand out there, generally it's been an issue surrounding scalability of management.
Right.
And then the second lesson that we've certainly learned is you've got to be really clear about the alignment for exit. And so having those conversations, having the frameworks up front that enables us to realize value in our time frames alongside those entrepreneurs, we have learnt to our cost to make sure that you've had those conversations and expectations set right up front.
Great. Thank you so much, Nick.
More than welcome. Thank you.